Okay, we have four parts today. The first one is what is a public bank? Where we'll go into some of that. And second part is the public bank model versus the private bank model, which Alec will present. I will then go into a brief history of public banks in the world. And Alec will talk about what this program is not about. Mainly greenbacks, which is something different, but very good also. All right, what is a public bank? And by the way, I want to mention at the outset that I'm very impressed with the Henry George approach and read with great interest books by the leading scholar in this subject out in California.
Mason?
Mason Gaffney. Including the book, The Corruption of Economics, and several other books. So, and I think these two ideas, public banking and Henry George's school, are both very compatible in ways to restore healthy economies that really can work for everybody. So, what is a public bank? Can I control slides, or shall I say next slide?
Ibrahima.
Oh, okay. Here it is. A public bank is owned by the government of a city, state, region, or territory. Its mission is to serve the public good of that community. It reflects the values and needs of its community. It holds deposits of its government, such as taxes and fees. And this is as an alternative to putting those deposits in a big, typically Wall Street bank in this country. It invests in the public good, and its profits are used to benefit the public, not private shareholders. Alec will cover the next two parts of this.
Yes, money as a public utility rather than a private good or service that is produced by a private corporation such as bank. So if something is a public utility, it means that it is to be used for the common good. And that implies, in turn, to define what constitutes a common good, something that everybody actually needs as a result of living in a particular country, and in a certain way has a right to it, like clean air or water or housing or what have you. So that it's something that has been given as a gift. For example, nature has been given as a gift. We don't have to earn the things that nature gives us. We have to live in a society that provides us access to those, whether we've earned any money or not. So money as a public utility is sometimes thought of as equivalent to what we have with the national parks, yes? That even though they are owned by the government rather than a private person or a private corporation, they're owned by the government, but the government must use the parks in order to benefit the well-being of all Americans. It's not to be used to benefit certain political interests. So the same thing with respect to money as a public utility. I think this is, for me, has become very, very important as a notion. The second thing, of course, is that money has as its burden, as it were, to be used for the common good. That doesn't mean it can't be used for a private good, but its production is to be put in the hands of the government that represents the public good. Of course, we're talking about a good government that is a responsible government and that does use the ownership of something as for the common good. So it's a moral issue in that sense that it has to serve people's well-being, again, independently of the nature of the people that we're talking about, whether they're men or women, whether they're black or white, whether they are educated or not educated, etc. So that's the idea about money being an instrument to further the ethics of a nation, if you will.
Yeah, I want to add just a brief
Yes.
point to that on the moral issue. By not having public banks, our money is being siphoned to the wealthy from the middle class and the poor. And this is depriving people of health care, it's depriving people of their homes, making hundreds of thousands of homeless in this country. It's depriving people of education. This is a serious moral issue. And that's why some of us are so serious about wanting to change this by establishing public banks. All right, next slide. The United States has one state-owned depository bank, the Bank of North Dakota, which does a great deal for that state. It was the only state to escape the 2008-2009 Great Recession. That incites disbelief in a lot of people. But the fact is that a public bank, because it serves the public interest and holds the deposits of the state itself, it's not going to withdraw its deposits in the face of a recession. It keeps them there and actually increases lending to keep the economy going. And if it has to, it may refinance, give more time for people to pay on their homes or their businesses, because the goal is to keep the economy going. And that's what North Dakota did. It increased lending, contrary to everywhere else, where the private banks, thinking only of themselves and their shareholders, think, oh my God, the sky's falling, we better take our money out. And of course, when they do that, it just guarantees a crash, if not a great recession. So what other things does North Dakota produce? Has the nation's lowest unemployment rate, lowest default rate, say in student loans and credit card default, one of the lowest home foreclosure rates. It has the most banks per capita because it works together with community banks and credit unions to make loans jointly with them. It actually strengthens that system. And its profits are outstanding. The Bank of North Dakota has actually averaged 20% return on equity for the past 20 years. This is much better than Goldman Sachs or JP Morgan Chase, who also actually failed or had to be bailed out during this same period. Are you able to advance the slide? Can you hear me?
Yes, I can hear you. I can't. Just hit the arrow. We'll go.
It's not moving. I don't know what's happening. That's strange. There. Okay. It worked that time. Why is the Bank of North Dakota so profitable? A very broad look at it is very low overhead and safe loans. For example, a number of features. one of the first and most important is it does not have CEOs who are paid mega salaries like 20 million or 40 million a year, or major bonuses draining billions of dollars like the big banks did during the 2008 crash. It doesn't advertise. It has no taxes to pay. It's by statute exempt from taxes. It has a massive deposit base, all by law. All the state revenues are put, instead of in Chase or Wells Fargo or another major bank, they're put in the state bank. It partners with local banks, as I said, in making loans. Community banks, so-called, which are private, and credit unions, and they act as the front office. They actually take the application, meet the borrower, review his credit and ability to pay and what the loan is for, how they're going to make a profit, and they make a decision, and then they decide, well, we would like the Bank of North Dakota to help out with this, either to take it over or to share in the lending, say 50-50, which is very commonly done. And so there's no need for a local branch office. The bank saves money that way and helps the local bank make more money. It can take on loans it could not otherwise take on because it involves more money or more risk. And it also has no need for an ATM, which are provided by the local banks. Another very important feature of the bank is not paying commissions or fees for making loans. That's a very unwise approach, which was used leading up to the Great Recession, which incentivized subprime loans, so-called liar's loans, which are never going to be paid back because the loan officer is getting all this money up front. There's no reason for him to even worry about whether it'll be paid back. Also, a major feature of public banks is very safe lending. They have a very low default on loan rate, like sometimes less than 1%, 1 point some percent. Better than the average for private banks by a significant margin, maybe a third lower. That way the bank can never fail. And the Bank of North Dakota has never failed and never suffered losses, profitable every year. It has no private shareholders to take a lot of the income away. Instead, the income can be shared with the taxpayers paying into the general fund, or some of it can be paid into the bank and used as capital, what's called paid up capital, that allows the bank to increase its lending by up to 10 times the capital. So that's a way for the bank to do even more. All right, Alec will take this next phase, which is comparing the model of a public and private bank in terms of its lending, which is a very advantageous feature of a public bank, as you'll see.
So we start off then from we the people, where I have my arrow, who provide labor and are paid dollars. And here, the next phase is that these people then, as a result of making an income in the form of dollars, pay taxes and fees. We're talking about either a state bank or a city bank, not a federal bank at all. So these go to the local government, either state or, as we said, city. Now, these funds that are collected from the people of, let's say, Colorado, they're deposited in private Wall Street banks. There are some deposits that are put in some local banks, but the very large percentage we discovered is put in private Wall Street banks. Then these Wall Street banks take the money, use the capital that they have and make loans. When they make loans, they don't take the money from the deposits and loan that money. They create new deposits. That is to say, a person comes to a bank who wants to borrow money, wants to borrow, let's say, $100,000 to expand his or her business. That application goes to various people in the bank. They look up who you are, what kind of experience you have, whether the product is really going to sell at the rate and at the price that you claim in your business plan, and various other checks to find out whether this is a viable business. And so let's say that they approve the loan. So you get a call from the bank and they ask you to come to their offices. When you get there, they don't take money from other people's deposits and loan that money to you, which some people seem to think is the way that banks operate. Not at all. They just open an account in your name, in the borrower's name, and type in $100,000. And that $100,000 is for you to spend according to your business plan. So they create those loans, and in the process, and this is terribly important, they create new money. So we take it now anymore as a given that banks, whether public or private, create new money every time they make a loan. This has been challenged time and again. Bankers themselves claim that that's not what they do, but the research that has been done, it's definitive. It's a definitive opinion that banks create money when they make loans. It's the equivalent of saying that the earth is round rather than flat. That's how certain it is that banks create money when they make loans. Now the question is, what kind of places do they make loans to? And the big private Wall Street banks make loans to these categories here: armaments and war, fossil fuels, toxic chemicals, big pharma, private prisons, derivatives, speculation, the government projects for privatization, yes?
Yes.
Speculation, asset bubbles, real estate, stocks. So for example, the bubble in terms of the prices of houses and buildings and rather real estate in Denver is sky high. And it's a result of using the loans to buy houses and real estate, sit on it, and then sell them at a higher price rather than as productive investments. The term investment in economics has two meanings. One is that, or rather it's used in two ways. One is to say that, to distinguish it from consumption by saying that an investment is unlike consumption, is that when it is spent, you expect a return. Yes, but you can expect a return in two ways. One is through productive investment, that is to say, you create new products and also create new jobs, which in turn produce an income, which in turn produce taxes, etc. So the money is returned in some manner to the state, or you make money, you make a return on your investment by speculation, right? And you're not producing anything worthwhile for the economy. You still make a return on your investment, but it's not a productive investment. So only the people that make those investments benefit and not the larger community.
Yeah, another point, you see government 3P projects. 3P stands for public-private partnership. And those are promoted a lot as something very positive, but we maintain it's not a positive thing. It's really a form of privatization. The asset goes into private hands and the taxpayers end up paying the interest on those. They're not really establishing a net public benefit. And the asset bubbles that you see at the bottom in the area of stocks, the Great Depression of 1929 was actually the result of inflating stocks very irresponsibly. The private banks were pumping money into the inflation of stocks, and they bought a great deal of them, let the economy go up to the top, and they knew ahead of time when they were going to start cutting lending and could sell out at top dollar. And then we had the Great Depression. In 2008, in the Great Recession, we had instead a primary bubble in the area of real estate, which again, the private banks were pumping up a great deal of money into the purchase of real estate, and the Fed, or the Federal Reserve, which is 100% owned by the private banks that own the 12 branches, lowered interest rates to keep it going until it reached the maximum state ready to burst. Again, they sell out at top dollar and let the economy crash. That is the problem with our current system that allows public banks, by having our money in their banks, to decide how to invest that money. They can invest in asset bubbles if they want to, because the laws don't prevent it. With a public bank, we stop that. But anyway, that's the next slide, which Alec will talk about.
It isn't in there. You don't have that slide.
Oh,
There.
how could that be? Okay.
We don't have it in there.
Is it all right if we take a break for just 1 minute? I think we want to get that slide if we can.
Sure.
You guys are muted.
They are looking for a slide, Ed.
All right, I think we're unmuted. Here is the slide we were looking for.
And before we go to that piece, very appropriately, Earl talked about inflation. So it matters whether you inflate the economy as a whole, the real economy, where prices of goods and services go up in general, versus inflating it in the stock market or in real estate. Also, it matters a great deal what the cause of the inflation is. So, for example, again, to this last month or so, or 2 months, the prices have been going up. But the question that, and then the administration is blamed for it as if it's done something wrong, even though the cause of the inflation is supply side inflation, the same kind of inflation that we had in the 1970s as a result of a restriction of supply that we were not responsible for. In this case, there's a restriction of supply of all sorts of resources due to COVID. You can't blame somebody for the restriction of the supply. You can blame the government or others, including businesses, if the supply is due to a demand surge over the capacity of the economy to produce, in which case you can really say that the administration or other people or other entities are responsible for pushing the economy in a way that it can't really produce the kinds of goods and services that it's asked to produce. All right then. Now, with respect to this other model, with the public banking model, you will see that, again, we, the people, we start here providing labor. They make an income. That income is taxed, as well as fees being paid. Then this money goes to the city hall. And then instead of these deposits being put into a private bank, they're put into a city-owned public bank. It can also be a state public bank. That public bank, or these public banks, because in the state you can have several public banks, can also loan money by creating new deposits, creation of new deposits over here. And so these loans can have either no interest or a low interest. The reason being because of what Earl said earlier, that the bank does not require very much income to run itself. So it can loan monies for a very low level of interest. And look at the kinds of things that a public bank, and these things are not theoretical. We know that public banks do that. And the way that we enforce that kind of doing is by having a charter that directs the public bank and the governors of the public bank to actually make those loans, and they're not allowed to make loans other than those, namely speculative and other kinds of loans. And you also have, apart from the charter, you also have a board of directors that is responsible for following the charter. And we have here the kinds of things that they can finance. They can finance the government debt at a much lower rate of interest, the local government, of course.
Yeah, or
Or-
even if they were to charge the same rate of interest, that income now, instead of going to Wall Street, goes back to the public bank, which can allow it to increase its lending, as I mentioned.
Yes. Or it can refinance the government debt. If there is a government debt that is already in existence, you can refinance that government debt at a low rate of interest. Then it can go into infrastructure. Notice here that you can have expenditures on infrastructure without increasing taxes. You can go to small and medium-sized businesses. Loans to small and medium-sized businesses by big banks have really, really shrunk. so that small and medium-sized business find it very difficult to get loans. Affordable housing and home loans. Denver in particular is, I think, only second or third to San Francisco in terms of people that are without housing. I mean, it is really unconscionable the number of people that are forced to live in the open. Student loans and education, as we know, those have become even greater in total than the amount of debt for credit cards in the United States. I think it's $1.5 billion.
Trillion.
Trillion dollars?
Trillion.
Yes,
Trillion,
yes, sorry,
trillion.
$1 trillion. And it imposes an enormous burden on people who have attempted to use education to get out of their poverty or to even have a middle-class income. So healthcare, clean energy, broadband, all of those things are, we know from the general public that those are things that really people want to have. This is not just that Democrats want to have that or some radicals want to have that. This is the will of the American people to want these kinds of things. And we really come back and say, well, where will the money come from? We can't afford it. Well, with a public bank, we can have that money because with a certain amount of capital, you can produce loans that are, as Earl was saying earlier, 10 times the original amount. Sustainable agriculture. This, of course, speaks to the whole issue of the climate crisis. We don't anymore call it climate change. We call it climate crisis. And somehow or other, we need to be talking to people that are outside the cities. This is something that I have said before, that the Democrats have really lost the major opportunity to speak to people who live outside the big cities.
Yeah, sustainable agriculture also relates to reducing or eliminating the use of toxic herbicides and pesticides that damage the soil a great deal. And also confined animal feeding operations that are very unhealthy, produce sick animals that even have difficulty reproducing. Go ahead.
Yeah, and then publicly financed elections. That's one of my favorites. It seems to me that it doesn't really matter how much you restore the capacity of people to vote and see to it that they can find easy ways of voting. If you don't attend to the issue of elections being financed by very, very powerful and wealthy entities, you're really going to, we are really going to continue to suffer the undermining of democracy in the United States. And the same thing holds with respect to independent media. I mean, even with liberal media in the United States, MSN, BC, or CNN, I mean, you have sometimes very good analysis of what it is that's going on in the United States and elsewhere. And the next moment you're being sold cars, or you're being sold soups, or you're being sold medicines that have a list of side effects that are very, very nasty for you. So there is this distraction that takes place that works at the expense of we the people. Okay.
I just admitted Paul.
Okay,
Yeah. All right, we're ready for the next slide. Oh, by the way, there's a tree you'll notice on the lower right with
yes,
money on it. That's a very deliberate slide.
yes, that's true.
And you heard Alex say that when money is created by banks, they are actually creating a new deposit, money that did not exist before. And we've all been taught that money does not grow on trees. And what this symbolizes is the very important point that money actually is created anew. And therefore, it's a very serious thing when that is turned over almost entirely to private banks to use that money for their own benefit and not serve the public good. That fact makes it extremely important to have public control to ensure that we serve the public good.
And by the way, for you lawyers out there, isn't it the case that in the Constitution, the entity that was designated as being the one to create money was Congress? Isn't that in the American Constitution?
Yes, Congress
correct.
is authorized to coin money is the actual term.
Yes, because at that time, that's what.
But a good analysis in a law journal, the Harvard Law of, I think, Public Policy, about 10 years ago, showed that the term coin included paper money. It did not require physical metallic coins, as some people have interpreted it.
Mhm.
But it included paper money, and a Supreme Court decision during the Civil War or after the Civil War held that the section of the Constitution that provides for that, Article 1, Section 8, Part 5, includes the printing of paper money. And that's a very important point.
Okay.
All right, next slide. All right, now we'll do a brief history of public banks. The origin of bank-created money is important. It really arose out of the 17th century goldsmith, who discovered that when they held for security purposes people's gold so that it would be safe, they would give a receipt for that gold, let's say $100, and they discovered that most people did not come for their gold all the time, but only about 10% of it. And they found out that they could actually issue receipts up to 10 times the amount of gold they actually held on deposit. Of course, if everyone came for the gold at once, they'd be very embarrassed and would have to say, "I'm sorry, we don't have the gold," which would have upset everybody.
And it's called a run on the bank these days.
Yes. But they could make a great deal of money by lending out, in effect, 10 times the amount of gold they had on hand by issuing these receipts. This was called fractional reserve banking, where they held, 10%, say, on reserve and loaned out the equivalent of 10 times that much. Actually, during the COVID crisis, the Federal Reserve eliminated the reserve requirement, and banks could lend out quite a bit more than that. Although some banks were lending out more than that, actually leading up to the great crash, Great Recession of 2008. We had publicly owned banks in the United States, or actually during the colonial era preceding the United States. In the early 1720s, about 1723, the colony of Pennsylvania and other colonies were authorized by the British Parliament to lend money, which they did through land banks, and they're also able to print their own money and spend it into their economies. Well, this enabled the colonies to be very prosperous, which is described years later by Ben Franklin. And Franklin also, in the year 1729, anonymously wrote a pamphlet that described the great benefit of this money. It had been in use now for 6 years in 1729, and he found it had greatly increased prosperity by being able to create their own money and spend it into the economy, and to lend new money through their land bank. And they did not have to lend taxes. This was a source of interest and of new money without having to levy taxes. So the colonies were able to prosper with very little taxation. A next major development, well, actually during the Civil War, during the Revolutionary War, the Continental Congress created money in the form of the Continental dollar. And that again was created out of money. Oh, okay. That again was money that was created by the government without having to borrow money. And it enabled the colonies to be very successful in the Revolutionary War. And of course, they beat what was then the world's largest and most powerful army of the United Kingdom. And it did so by this, with really without having its own money. It had to create it to do it, which demonstrated the power of that. But there was something that was not known about what also happened during that period, and that was that the British were counterfeiting the Continental dollar. They brought their own machines in on their ships and were creating vast amounts of notes that looked identical to the Continental dollar. It was not that hard to counterfeit those dollars at that time. And that greatly reduced the value of the dollar and created inflation. And that was one of the reasons for the great mistake that was made when the first Bank of the United States was created after the government was actually founded. Of course, in 1788, the Constitution was passed, and the next year, the government came into being in 1789, in 1790. And in 1791, the government created the first Bank of the United States. The problem with that was that Ben Franklin, by then, was he only lived another year. He was not active in politics. He was the one who understood the vast importance of the colonies being able to create their own money, both by lending and by printing their own dollars. And unfortunately, he was not part of this decision that was made to create the first Bank of the United States. And when that was done, that bank was 80% privately owned, and eventually grew to be owned in large part by foreign bankers, such as in Great Britain and the wealthy in Great Britain. And it resulted in, by being privatized, it resulted in a lot of bad loans being made and rapid inflation. And Jefferson complained that the finances of that bank were indecipherable and were not responsible. And As you know, that bank was closed 20 years later. We were then suddenly put into the War of 1812. We won that war, and in order to finance it, there was a lot of pressure to borrow money and create money, and there was pressure to recreate the second Bank of the United States, which was done in 1816 with a 20-year charter, just like the first bank. And that also was roughly 80% privately owned. So it had problems, but it did create money, and it did generate lots of lending that allowed the fledgling United States to grow and grow fairly rapidly economically. But one of our great economists, a man named Alexander Del Mar, whose name you should write down, a brilliant self-taught economist, wrote that the United States created this great revolution, but then it created this disastrous failing, which was to create a bank that was mostly privately owned, that put the control of our money back into private hands. And he was comparing that with the colonial period and with the revolutionary period, when the country was, as it should be, creating its own money. And then finally, in the 1800s, some states formed their own state-owned banks. They were not terribly well designed. They did not have carefully constructed governance to prevent its takeover by private parties, to prevent its being controlled by private parties. And those banks did not last long. Some of them were very helpful to their communities, and that really demonstrated the power of a public bank. But that handful, or the 8 or so banks, eventually all closed during the 1800s. Some lasted longer than others. And then we go to the 20th century. In 1911, the postal banks were created. These were not actually banks in the true sense of the word. They were not able to create deposits, to create new money, but they were a place people could deposit their money safely. And it was just at the local postal office. It was a great idea. It protected people's money and lasted a long time. And it was a great mistake to close those. There's an effort now to restore them, which is a great idea. And there's national legislation to do just that. In the 1930s, in 1933, the Reconstruction Finance Corporation was created. And that was used once Roosevelt got into office. Hoover did not use it properly and just let that money be used to fatten the Wall Street banks, which did not get into the economy. But under Roosevelt, the Reconstruction Finance Corporation put $35 billion into the economy. That did much to help us get it out of the Great Depression. And it also helped greatly to fund much of World War II. It was gradually allowed to decline in importance and lend less money, and was unfortunately closed in 1957. It should have been continued. It would have been a source of much more public investment in the commons. And finally, in 1919, the Bank of North Dakota was founded. It was a huge effort over a half dozen years or so. And a group called the Nonpartisan League, neither Republican nor Democrat, campaigned to take control of some of the businesses and finances of the state that have been controlled by major banks and especially the railroads and granaries at a national level that were making farmers poor and having to pay too much interest. So they got control. They were very successful over several years of campaigning, and they won control of the legislature, the governorship, and also the judiciary. And they, among other things, they created a state-owned granary and they created a public bank. And the Bank of North Dakota is still in business 103 years later and has been very successful, which you heard us describe up above. And its current record of 20 years of 20% return on equity, which is truly remarkable. Also in the 20th century, there have been other publicly owned banks. The Bank of Canada, a nationally owned public bank, was very effective between 1939 and 1974. It rapidly, within about a year, brought Canada out of the Great Depression. It enabled Canada to fund a very significant part of World War II, and it vastly increased the strength of its economy so that by 1971, after over 30 years of having this nationally owned bank, creating money and funding its national economy, it was able to afford national health care. Its public bank played a big role in that. But unfortunately, the major bankers in 1974 apparently got inside the bank and helped create pressure to have it become part of the international privately controlled Bank for International Settlements, that is the private central bank for private central banks around the world. And so it died out, and Canada's had the same problem we've had since then. Another major set of public banks are the German Sparkassen in 1,500 cities, gone on for 200 years, no failures in that time, and they've been the backbone of its economy and are still going. Some other examples: China, South Korea, and Japan. One of the reasons for China's very robust economic growth and economy is its world-leading public banks constituting about 80% of its banking assets. South Korea grew very rapidly and is still leading in many economic fields, as we know. Japan was somewhat more robust, but is still doing quite well with one major national bank. And areas like Syria, Iran, Russia, and Costa Rica are some other examples of public banks. Australia in the past, and New Zealand, which still has a postal bank that is able to create publicly owned money. Globally, 25% of banking assets are publicly owned. You can see the darker areas are where the Black, China, India, in the Middle East, South America has partially owned public banks, Russia and Mexico, and also in Algeria and Morocco. And Germany is partially has the Sparkassen that I talked about, and some of the Eastern European countries have had publicly owned banks. In the United States, there have been extensive efforts over the last 11 years. The National Public Banking Institute, and I want to give credit for a number of these slides to Ellen Brown, the author of Web of Debt, the book, and also the book, The Public Bank Solution, and also Her latest book is Banking on the People. These are three outstanding books that I strongly recommended to read. There are 18 new public banking bills introduced in 2021 in 8 states. 30 states have proposed public bank bills. Some are not still pending, but the effort still is ongoing, including here in Colorado. Over 50 organizations nationwide are promoting public banks. So Alec will cover what we're not covering today.
Yeah, that's right. Or in this class
Or in this-
altogether.
or in this class.
Altogether. So, and then we'll open it up for any questions or comments or, longer questions. So a sovereign country is able, a sovereign country, that is to say, a country that has a monopoly of being able to create its own currency, should be able to create or print its own money to pay for the production of new goods and services. It has the power actually to do that independently of what the money is used for. But certainly it can be used for very good purposes. Such creation of money does not involve either a loan or the creation of a debt. It just issues the money. That's the modern monetary theory idea, yes, which is not really very modern. It has the backing of some very prominent economists from the past. The 13 colonies did it for a while and were prosperous, as Earl mentioned and underlined before. Abe Lincoln was the only president to do it in quantity, and he called the money goes by the name of greenbacks. Many countries have turned over money creation almost 100% to private banks for the bank's profit. So, and this is the last word for today from us. We're not talking about that in this course. The sovereign country and the capacity to create money without creating any debt and therefore without charging any interest is only a right and the capacity that is given to sovereign governments, the federal government in the case of the United States.
However, a little footnote here, that being true, because the United States is not doing that, and 97% of our money is being created by private banks, we're not behaving like a sovereign country. The same thing is true in the European Union.
Yes.
Member countries of the European Union are not permitted by the European Central Bank and the law that controls that to create their own money. A major reason for the huge crisis in Greece and that have existed in other countries.
That's right.
All right, well, let's turn it over to questions.
Well, we talked quite a bit and you were silent, so get to it. And especially would like to hear comments and not just questions. I see Ed is in the room, so I know him from other classes, but whoever it is that wants to go.
Well, Marty Rowland has his hand up, so let's take
Yes,
Marty's question.
Marty too, has
Oh.
been in other classes.
Great.
Hello,
thanks.
Marty.
Yeah, I appreciate the course. I think the benefit of this, and it's being presented very well, is that we're in the middle of a MMT class, and now we have this public banking, and I'm going to be giving a course coming up in June. But I think maybe next year somebody will need to weave all these together, because I think each of them have an element of the solution. And so that's great that you're presenting that. I don't think it's totally necessary to get worked over some of the early history of the United States, but I've got a well-researched book on Gallatin, who is the Treasury Secretary after Hamilton. And when Jefferson wanted to ditch what Hamilton did in the First National Bank, Gallatin said, no, it's working well. And he didn't hardly do any changes at all. So I think they're a little minor correction in history.
Thank you.
Good point.
And Paul, you have to unmute yourself.
There you go. Hi there. I'm sorry I'd come in late. I was still at
No,
work.
but speak as loudly as you can.
Okay, how's this? Is this any better?
Yes, but we can do with louder sound.
Okay. Hold on.
Well, but start talking and we'll see what happens.
Okay. Tell you what, come back to me. I just took out my earphones and maybe
No, we can hear you very well now.
We can hear you fine. Ed Dodson.
I guess my question, it's a question that I don't know the answer to. Is the Bank of North Dakota in effect an intermediary only? In other
No,
words,
Not entirely. It makes about half its loans, or 2/3, in conjunction with community banks and credit unions in partnership loans. It acts as a banker's bank. It also clears checks, but it does make loans directly to students or former students. It's handling quite a few student loans.
Earl, let me re-ask my question more intelligently.
Okay.
Does the Bank of North Dakota only lend money it has?
No,
No.
it creates new money
Ah.
when it makes loans.
Yes.
Now, would you agree that that is a capacity that should be eliminated by law?
I know there's an argument for that. And there are two schools of thought on that. Richard Werner, who is the person who showed definitively that public banks, that banks create money out of thin air when they make loans, so-called fiat currency, argues that it's a very valuable power, but it's being presently badly misused by turning it over entirely to the control of private banks that use it mainly to maximize their own profit, very much at public expense. But that if it's put under carefully, democratically controlled public control, as in Germany, and he cites the example of the Sparkassen, now 200 years running, it can do a great deal to create a strong economy. The Sparkassen only constitute something like 30% or so of lending in that country, but it's really made, it's been the backbone of Germany's economy. It has been the main funder of small and medium-sized businesses. It's very democratic because there are 15,000 branches, and those local branches know the local borrowers. They lend money to them, and Germany has the strongest export economy largely due to that funding. But there's a very strong caveat that it has to involve very careful controls to eliminate conflicts of interest, to ensure public control for the public good, and to make it transparent and to serve the public good.
So let me ask a question in turn, Ed. If we didn't have banks, either private or public, creating money, who would then create money since we need it? And if they're not created in the right amount, we would be wasting the capacity to use our resources appropriately.
My answer would be fairly long. I don't know, want to take up a whole lot of time now, but let me just say that any bank that is started raises capital from investors. Those investors could be public entities, could be the government. And then uses that capital to start business. And if they need additional cash, they can issue bonds. They can go into the credit markets. They can offer services in exchange for fee income. But I mean, I'm a 40 years in the banking community, and it only has been the last couple of years when I've finally, came to realize that this fraud, what I consider a fraud, was ongoing. I managed the bank department. I never, I always had limits on what I could lend as a lending officer based on the assets the bank had, or at least that's what I was told. So,
what is it that you consider a fraud?
creating that an individual bank, privately owned or even publicly owned, should be able to create money out of thin air with which to make a loan. The loan should come from existing assets or assets raised in the credit markets somehow.
Well, that is the assumption that is being challenged altogether. That money need not be earned by the government that issues it. And if you say that it has to be backed by assets, it means that it has to be earned.
Well, I have no problems with the United States Treasury creating money out of thin air and spending it into circulation under certain constraints. But once that occurs, I do not believe that a banking entity should then be able to do the same thing.
Well, that's an important question, because we've had, since this country was founded, we've had private banks doing just that, creating new money. And we've had recurrent recessions from almost the very beginning. Around the time of the War of 1812, when that ended, there was a huge recession. 1837, and these kept happening. And that is a product, we maintain, of turning over the creation of money by banks entirely to private banks. If there's public control and the bank is limited to lending, or primarily limited to lending, for example, to produce new goods and services,
and for the common good,
and for sustainable projects. Let's not invest tons of money in weapons because they're very profitable. In fact, I want to say something about war and banking. War and weapons are often the most profitable enterprise for banks. The government guarantees the loans. The spending is unlimited. After all, you're in a war, you must win. So the spending increases. The banks often fund both sides without the knowledge of either. And the government guarantees that it will pay the debts of the loser. And so it's a huge bonanza for the big banks. And the interest rates are not adequately controlled either. So,
okay, but this is the issue that Ed is bringing up, is that if we have the federal government produce all the money that is needed, why give this kind of capacity to state banks, private banks, municipal banks, city banks, etc.? Am I understanding you correctly, Ed?
Exactly.
Okay, so let's move on to some other questions.
Okay.
Because there are some other people.
yes.
I'm back, by the way. Sorry.
Okay, very good, Paul.
So I understand that we're really not discussing in this seminar the concept of the U.S. government creating money, and you outlined it very well, I thought.
Yes,
And for me, that's absolutely the ultimate goal. However, it seems that anything we can do to take the power of money creation away from private banks is a good intermediate step.
Yes.
My concern though is that we're still creating money through the process of debt creation, and that's what's really hurting this country. It's not only the national debt, but it's private debt, and also money is created primarily for businesses, and it has to still trickle down to the rest of the population. So I see public banking as a step in the right direction, but it's still got the problems inherent in private money creation. So, and also banks still have to make a profit. They have to get a return on the investment or else they go bankrupt. So
Yes.
there's an incentive to make very low risk loans. So I'd just be interested in what you think about that and if that'll be discussed at all.
Yes, I agree that the public banks can be an intermediary to, something that can be done on the federal level. It seems to me, however, that it's a very good alternative to big private banks for the local
Sure.
communities. And that,
Absolutely.
that the idea that it's going to altogether the loans will only go to businesses or even large businesses. No, we've said time and again that they would go into small businesses that take much longer to create a profit and therefore be able to return both the loan and the interest. But the public bank is not there to exist in order to make a profit. It's to serve the common good, and can't do it on a continuous basis if it doesn't also make a profit. Otherwise, as you say, it'll go bankrupt. But its planning horizon is 25, 30 years rather than a very, very quick turnover, which tends to mean that the loans go to speculation rather than to productive activity. Okay. So let's see, who's next? Joe
Polito,
Hi, great presentation. Really like the way you organized it. And I'd
Who
also
do you
like to
think, Joe, who do you think was better, Joe or me? It's a very, very difficult question.
somebody won by a nose, I can't say.
Okay.
I also like to comment that we have a terrific group in the chat. I don't think I've ever read so many good comments in the chat before. We've got Thomas and Timothy and Ed and others making great comments. I put in a couple links. One was about, just because this is Henry George, there's some interesting proposals coming out in our provincial elections. So I put a link into that. You folks can see that. And they're Georgians somewhat, they're moving in that direction. It was positive. Secondly, I put in a link to Ryan Collins' paper on the Bank of Canada, because you folks mentioned the Bank of Canada there. And if you look at figure 1 and 7, people can check that out later, but you'll see that there was before 1980, a higher level of debt, higher percentage of debt held by the Bank of Canada, more monetization, if you like. But it wasn't incredibly high. It was like 25% maybe. I think in the States it's probably about 15 prior to COVID. And ours went back down probably to that. And then, with the COVID thing, it's probably at 30% or more. So that is a very important factor that was mentioned, but it's not, it's not nearly as much as you'd hope. But it does show, when you consider what was done in Canada in those years, it does show, I think, as was mentioned, that it's a very positive thing for infrastructure and prosperity. And so I put those 2 links in. Thanks again. Great presentation.
Thank you very much.
thanks very much. And by the way, I see Scott Baker on the chat. He's, of course, been a longtime New Yorker and Henry Georges, and was the leader of that group, I believe, and of course is one of the national leaders in public banking. So I hope maybe he'll speak up here.
And Tom Greco, you need to unmute yourself. Tom Greco?
Tom Rossman?
Yeah, hi. Great presentation, guys. Really excellent stuff. I'm wondering if there are any metrics on how much more efficient, for example, there's a lot of metrics on how much more efficient Social Security is and Medicare is in processing their claims and conducting their business than private insurance companies. Are there any metrics for how much more efficient public banks are than private banks in terms of lending money? And then also, is there another set of metrics on how much additional benefit the public gets from public banks over private banks?
There are some measures. The Institute for Local Self-Reliance, which I think is out of Wisconsin, has written some wonderful articles about public banking and the Bank of North Dakota, showing how extremely beneficial it has been to the state of North Dakota and its small businesses, to the community banks in North Dakota and credit unions, which there have been no bank failures in North Dakota for many years. Going back 20 years or so.
Not only from the public Bank of North Dakota, but also for community banks, because they work so closely with the public bank. That is to say, the public bank helps community banks really do well.
By making loans jointly with them and helping ensure that those loans are low enough interest to be repayable and guaranteed. And they pick up some of those loans, and when it's real estate, they don't pass it on, unlike is being done by the major banks, where, as you know, these package loans are often irresponsibly managed. The Bank of North Dakota keeps those loans when it buys a loan from a local bank, and the local bank can then take on another borrower.
Earl, give the example, which might be a way of measuring the effects of a private bank versus a public bank, of the situation with the river flooding in the area between North Dakota and the state next to it. That's a very good example of.
Yes, there were at least two floods that illustrate dramatically the difference in behavior of the Bank of North Dakota and what happens in other states. There was a very bad flood of the Red River in North Dakota in 1997 that wiped out a large part of the banks of the Red River, businesses and homes. And the same thing happened to the city immediately across the river in Minnesota. But the Bank of North Dakota stepped in immediately, declared a moratorium on loans of people and businesses, enabling them to get back on their feet. They stepped in with loans right away, and they lost very few of the residents. Only 3% of the residents in the flooded out area ended up leaving. In this town immediately across the river without a public bank, they lost 17% of the residents. The same thing happened in the later flood in North Dakota.
So that can be used as one measure, not necessarily a complete measure, but.
No, and there's another more recent measure, and that's during the the COVID recession, which of course was very severe, the Bank of North Dakota stepped in more quickly than any other state to help its businesses get 3P loans. And they led the nation in that and had something like 10 times as much as the state with the least. They're very public spirited. Another public bank that we haven't mentioned is owned by the Chickasaw Nation. This is in Oklahoma City. It's a public bank that was founded in 2002 with just $7.5 million in assets, which is fairly small for a public bank, but enough to get a start. And they have grown to $200 million in assets just 20 years later. They're considered the best place to work in Oklahoma, or in I think the best place to work in Oklahoma. They've been very highly rated by some national rating systems as a bank. They've been profitable and have had an excellent record of serving the community when things have been have gone when they've had economic problems. Okay.
Take this slide off. Thomas Greco.
Yeah, thank you.
Thomas, I remember you from a presentation in Naropa sometime in the mid-80s with, we were on the podium together with Bernard Leotard.
Yeah, I remember that. We were up there.
Anyway, go ahead.
Yeah. Well, I've been teaching for decades that we have this collusion between central government and central banks and the whole banking industry, actually. And you talked about the first and second banks of the United States. That was the institutionalization of that collusive arrangement in the United States.
Mm-hmm.
And
Yes.
we've been suffering under that ever since. And so it's not a question of public versus private banks. It's a question of who has the power to issue money and who has the power to control it. And I've been arguing that this needs to be widely decentralized. My argument against modern monetary theory is that you're still centralizing the control of money in the hands of a powerful entity. And I don't see that the Treasury allocating money is going to be any better for us than the banking cartel. So what I've been proposing for a long time, and this point was made in my webinar series that I did for the Henry George School last year. I did 3 presentations in May and June of last year, that we need to devolve the power to create money. And money is really only credit. And credit needs to be allocated on the basis of real value that is in the market or soon to arrive in the market. And I've made that point repeatedly. I don't think we can trust any centralized power, be it government power or private power, to control our credit. E.C. Regal made the point very strongly that only producers are qualified to issue credit and provide credit to the economy. And I won't belabor that point. You can research it for yourself. He wrote a book called Private Enterprise Money. And there was another book by Regal called Flight from Inflation. Those were the main sources of what I understand about money. And I would like for people to discover Regal's work and benefit from it as I did. So thank you for your presentation.
You're welcome. Thank you, Tom. Well, how do you spell Regal?
R-I-E-G-E-L.
That's
you
right.
go to my website, beyondmoney.net. The books are all free to download there.
Okay, I agree fully with the point that those decisions should be decentralized and localized. I think that's one advantage that community banks have, and that for example, the German Sparkassen are an outstanding example of that. I don't know, are you familiar with that, Tom?
Yeah, somewhat.
Okay.
Okay.
All right.
Yeah, are there other questions or comments? Ibrahima?
Well, I was going to ask a question, but I think Tom Greco's comment just basically took care of it. Because what I was going to say anyway was if you assign the money creation powers to a government entity, how do you guarantee that the money is not going to be created to favor some people who are well connected or some firms that have, but he answered the question. He said the key to that is to decentralize it. If you decentralize it, you are not giving any entity more power than others. So you can at least play the and balance the system.
That's part of it, but you also need one tool used by the bank in Alberta, which is a publicly owned bank in Canada, the ATB Financial. They have whistleblower protection. They have carefully written rules about conflicts of interest. They have committees that oversee that and make sure that those things don't happen. They did have a scandal about 40 years ago. They tightened the rules, and they've been very successful in avoiding problems since then. North Dakota has had good internal controls to prevent problems over their 103-year history. It's not that they've had zero problems, but they've been small and quickly overcome.
Okay, so basically improving the governance mechanism would be the solution.
Yes.
Yes.
Well, we'll see you next week then. Yes, and we have another 4 sessions.
Before you go, Ed has a question.
Yes, Ed.
I posted a comment earlier in the chat that despite the Bank of North Dakota's sterling record in the last 10 years, property prices in North Dakota residential property prices have increased by 40%. So it's not immune to the same credit-fueled, speculation-driven property market cycle that the rest of the country and most of the world is subject to. Mason Gaffney had a very interesting proposal, if it could ever be achieved, and that was to prohibit any financial institution that accepts government-insured deposits from extending credit for the purchase of land or the acceptance of land value as collateral. And it seems to me that that's something that the public banking effort might incorporate.
Yes,
I agree with that, Ed.
Thanks for that. Thanks for that. Do you remember where he proposed that? In which book, or was it?
Oh my gosh, Mason's writings are so extensive. I'd have to do a real search on my website. But if you go to my website and put in the search line, Mason Gaffney on bank credit, maybe it would come up. I don't know.
What's your website?
The School of Cooperative Individualism.
Okay, thank you, Ed.
Thank you very much, everyone. And thank you to our great speakers. We look forward to seeing you again next week.